Hello everyone, I'm Yamini from DSP BlackRock Mutual Fund. Welcome to our Fund Manager interview series today. We have with us Mr. Pankaj Sharma, our Head Fixed Income with us. Hello Pankaj.
Hi Yamini.
So given the current market rally, fixed income rally that we've seen already, and also the impending announcement of RBI Governor, Mr. Urjit Patel, that is also out. He's being considered a hawk. So where do we foresee markets in the near term? What is the interest rate outlook of DSP BlackRock?
First of all, thanks for having me. I'm very excited in this time right now where the market is. Interest rates as we see right now have drivers which are very different from what has been in the past. The primary driver that has driven down this rally has been the liquidity. Systemic liquidity has been driving the rates southwards, and I think all the headwinds we spoke about in the past, whether it was the CPI number going up, I think there were three actually idiosyncratic factors over there which were contributing to that, and I think all of those are right now actually having tailwinds. Number one, if we talk about the food inflation, the three components being fruits and vegetable prices, good monsoon rains will be coming down. Second one being pulses prices. The area under cultivation has gone up by more than 40%. I think the prices are also heading south. The third one being sugar, which is actually a water guzzling crop but doesn't depend on monsoon rains because a large part of it gets cultivated in the Indo-Gangetic plain. There, the biggest benefactor has been the farmer, which has got the arrears paid after 2-3 years. And I think all these three contributors to high food inflation will be heading south, and hence CPI numbers should be heading southwards. The other thing that you have to look at, the announcement of Dr. Patel as the new RBI governor is actually a vote of confidence. Why? Because the government has voted for continuity of the policy. Government has actually believed in the monetary policy framework which actually Dr. Patel had presented to the government, and government accepted that. So it's all those things are very, very good things for not only domestic investors but also the international investors. So I think interest rates trajectory should be heading southwards. The intensity might not be in the same pace like we saw between 20th of June and the 11th of August. But yes, today 10-year is at about 7.13%, and I think it has still scope to go downwards. It might consolidate at this level, but the general direction for the next 6 to 9 months should be heading downwards.
So you are saying that the entire fixed income rally as anticipated is very, very justified, and we see this now, the 10-year going further below 7, and when do we see this number?
So when is anybody's guess, but I think we can only talk about where the market is headed in medium to long term. And what we see is liquidity as far as the entire system is concerned is going to be quite benign. In fact, it's going to be surplus. And we are already seeing the overnight markets actually trading below the policy rate for repo rates that the Government of India or Reserve Bank of India has. So in that context, I think when you have a certainty, and statements were made during the 9th of August policy statement also, that RBI will be continuing its stance on surplus liquidity in the system. In that context, I think the overall environment will be very, very benign, and this holds very, very well for the entire bond markets. Now, why you have to ask why this is good for the overall economy? A large part of, if you look at a lot of borrowing that happens much at higher levels as compared to what the government bond market rates are. But what we have seen in the last 4 to 5 weeks is actually transmission of these rates happening in the corporate sector. At least the debt capital markets is seeing that happening. So I think it augurs very, very well for overall growth of the economy. The third thing which I think which will very, very important is India appears as a very bright star in the entire world. Okay, growth numbers are very good as compared to a lot of other countries. All other variables are very, very good, but India still is a investment grade country, but just at the borderline, BBB minus. Now, a lot of international investors, okay, who would like to commit long-term capital to India, debt capital, for them the margin of safety is very, very less. Okay, one notch downgrade means it goes into junk category, and they don't have capability or capacity to hold junk rated securities. In that context, I think if there is a rating action by the global rating agencies or India rating, that will actually be a big boost to the entire economy.
Okay, that's good to know. Coming back to the earlier point which we made on liquidity, we also envisage a huge FCNR outflow starting end of September, going into October and then November. So how adequately geared up is the system, the financial market system, for this event? Do we see some forthcoming event risk?
Yes, it is a large amount of outflow, and before I answer this question, what happens today or in the near term, we have to go back 3 years. 3 years back, Indian diaspora participated in this FCNR program. Almost $29 billion was raised. These dollars were given to the Reserve Bank of India. It boosted our reserves. It helped our balance sheet as a country. Now it is time to go back. When the money came in 3 years back, the net demand and term liabilities of the Indian banking system went up by $29 billion terms in rupee terms. Now when the money goes out, there will be 3 things that are likely to get impacted, and I'll talk about each one of them and how we think the impact will be very minimal. The first thing is, whenever a dollar outflow happens, someone has to buy those dollars. Okay. So what happens to US dollar INR FX rate? Now, if we have to see RBI's action, 3 years back it started buying these dollars in the forward market. So as far as the price risk on dollar INR is concerned, has already been taken care of. There are no naked positions as far as FX hedges are concerned. Second thing is availability of dollars. So RBI, when they say bought dollars forward, who are these people whom they have bought dollars forward from? These are banks. And banks buy dollars from whom? From exporters. So exporters normally do not deliver dollars, they roll over dollars. Now the question is, will we have a dollar delivery risk? There is a possibility. But since the last 3 years, our foreign exchange reserves in dollar terms have gone up by $95 billion. So in the worst case scenario, Reserve Bank of India will provide those dollars to the banks, and banks will provide those back to Reserve Bank of India. The third component, which is the most relevant for the Indian banking system, whenever this activity happens, rupee liquidity gets sucked out of the system, which will happen. But look at what RBI has done. In financial year 2016-17, RBI till date had already done open market operations of 90,000 crores. And as per the last policy statement, we believe about 110,000 crore is still pending. That means rupee liquidity will be provided into the system to take care of any of these exigencies. So I think there could be some small mismatches, but overall, if I have to go by the strength and the character of our central bank, I think we have, our central bank has managed all the previous crises very well. So there is a very high level of confidence. And one is central bank, the other thing is the political leadership that we have. I think we have a very strong political leadership right now. I think we don't expect any big shocks right now in the banking system.
So in line with the observations that we've just made, where do you think an ordinary investor, a fixed income investor today should invest?
It's an excellent question, very relevant in today's time, when if you look at what I said in my previous question, the general trajectory of interest rate is going down. Excellent time for issuers in the market because they can raise money at lower cost. Good time for bond traders because it's how you make money in the markets. But quite challenging time for small investors because traditional savings options that investors have are seeing rates heading south. In that context, mutual funds actually provide a very good alternative. Whether you want to use a liquid or liquid plus segment for transactory accounts, or short and medium term funds for your long term investment options, which could be 1, 3, 5 year investment options that you could have. And good thing about mutual funds is they provide you instant liquidity. You don't have a committed kind of investment horizon. So I think these are good options for investors to participate or allocate a part of their total corpus into the mutual funds. We have products on the short term side, we have products on the medium term side, and I think those provide a good investment option for clients who are looking to park their money for 1 to 3 years investment period.
Talking about small time investors, Pankaj, we have very successfully grown our income opportunities fund to more than 4,000 crores today. How easy or how difficult do you think is it going to be to scale up the fund further? Also, what is the general credit outlook on the economy right now?
A very relevant, pertinent question for a portfolio manager. I think when for DSP BlackRock, the biggest thing that matters is what is the size of the investment strategy. This is not going to be a perpetual product. There is a finite amount of size for this strategy. Today, we are able to manage this well. We don't want to take excessive risk. Taking risk is easy, but managing risk is the most difficult task. For us, whenever we take any issue or credit into our portfolios, we have to be very, very sure what is the maximum downside risk. Once we have ascertained it, then we decide how much we want to participate in that particular issuer. So today, we have a fund which is providing good investment option for the clients. We are looking at a lot of names in the market. Credit markets have not been benign for all the sectors. We have participated in stories which have been good upgrade stories, but there are sectors which continue to have some challenges. And as a portfolio manager and as a fiduciary, it is DSP BlackRock's responsibility to allocate only those securities or issuers where we have 100% confidence. And that will be the guiding principle whenever we construct the portfolio.
Thank you, Pankaj. Thank you so much for your time. Thank you, listeners. I hope you found this useful.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.